Aloha, my friends. Welcome to episode 2 of Ascending Traders. If you are new here, this channel is all about gaining insights into the financial markets through no fluff technical analysis and monthly guest interviews. As a trader or investor, attaining knowledge and applying it properly is one of the most important steps you can take. And technical analysis, hereafter TA, is one crucial component that can take your trading to the next level. For my trading style specifically, TA is the key to every decision I make. Some traders emphasize fundamental research reports, while others, like myself, care about price action. And you may ask, why is my decision making primarily influenced by charts? Well, charts help me act objectively on what is actually happening in the market. Objective trading means not being emotionally drawn into subjective narratives. And I mean, we've all done it, right? We buy into a stock, we watch price tumble down further, but our inner voice and other voices specifically tell us it's a good stock, don't sell, it'll come back. So instead of cutting your losses and allocating your money to another potential runner, you hold onto the stock because the fundamentals tell us a different, more optimistic story. Now, if you knew how to read a chart, then you know when to get into a trade and when to exit a trade. And here's a great example. Back in 2001, a premier energy stock began collapsing without further explanation. As price continued dropping, prominent analysts continued recommending to buy because their executives asserted damn good fundamentals. Fortune magazine even declared it to be America's most innovative company for 6 consecutive years. Even when technical levels started to break, fundamental analysts were relatively untroubled. Of course, they advised traders to continue buying the dip. However, the president and CEO of Enron bragged that the stock should be trading at 126 when it was currently trading at 80. Enron then canceled their deal with Blockbuster. Price dropped to the mid 60s. Other risky deals began unraveling. Management continued selling their shares into the bull market. 6 months later, the president and CEO resigned. At this time, price was trading around $30, and it wasn't before long the stock traded under $1. And of course, the name of this company is Enron, and they imploded in the early 2000s as a result of blatant fraud. Fundamental analysts work under the assumption that they are receiving complete and accurate information, but there's really no way to confirm that. On the other hand, one look at the chart should have clearly shown there was something wrong. Yet during its decline, Enron executives continued insisting that there were no wrongdoings. Everything was sunshine and rainbows, despite a continually declining stock that just failed to hold any support levels. So the moral of that story is charts don't lie. My goal as a trader is to help you read charts so you can make the most informed trading decisions. And I want to clarify, the reality is trading technicals does not mean that you're denying that a company has a bright future, but rather you are justifiably trading what you see in an objective manner. Charts provide a visual history of the market, and they tell us the strengths and weaknesses in various supply and demand zones, and these important areas can be used to anticipate future turning points. TA allows us to trade what is actually happening instead of what we believe should be happening. And because retail traders are typically not longing OTC companies, long-term fundamentals concerning earnings before interest, taxes, depreciation, price to sales ratio, and so forth are not major factors in moving highly volatile OTC stocks. I don't want to discount these valuation metrics because positive PRs involving mergers and acquisitions and future business developments certainly move price, and toxic debt and dilution can definitely dissuade traders from entering a stock to begin with. So of course, fundamentals play informative roles in price, which is why I choose to use both in my trading styles. They should be used in concert. However, TA can get a pretty bad rap, especially when traders overcomplicate charts. And the goal of this channel is to teach TA for the everyday trader. And for this episode specifically, I am teaching the main building block of contemporary charting, which is the Japanese candlestick. And over the course of this, you will learn the importance of Japanese candlesticks and how they can improve your confidence and execution in trading the financial markets. This is a real chart of ENZC posted on Twitter. My initial reaction to this is absolute disgust. I don't know why anybody would have the audacity to post this. This type of TA is a shit show. There are, I don't know how many indicators of all colors, shapes, and sizes. Where are you supposed to be looking at? It actually took me a minute to find the price chart, which is a joke. Which indicator do you prioritize in order to make an informed entry? Especially, how are you even supposed to determine an entry with all of these contrasting indicators? There's no way that you have full divergence between all of them. There's just simply too much noise. And I created ascending traders to combat this nonsense. At the end of the day, all indicators are derivatives of price and volume. Let me repeat that for you. Every single indicator, every single study you put on a chart is based on price and volume. Therefore, you have the capacity to technically trade without the need to clog up your charts with this superfluous crap you see on this chart right here. That being said, I don't want to reject the use of technical indicators because I use a few myself, but there's a pretty big difference between using a couple indicators such as Bolly bands, RSI, MACD, accumulation, distribution, moving averages versus what you see here. My TA mantra goes as follows: keep it simple, stupid. This mantra is the backbone of this channel. I want to simplify TA because it can help you become a more successful trader. And without further ado, let's look at the genetic makeup of a chart, candlesticks. Here we have a naked chart composed exclusively of green and red candlesticks. There are no volume bars. There are no technical indicators. However, this chart speaks volumes about the stock. How is that possible? Well, it's through Japanese candlesticks. Before we dive deep into Japanese candlesticks, let's examine the nuts and bolts of ticker symbol APTY. So here we have a period of consolidation. It's hard to tell at this specific scale, but price is actually making higher lows. There is a solid breakout at this level. So it breaks above this resistance, and you want one of two things to happen. You want price to continue climbing, or you want price to consolidate at this level. You just wouldn't want price to get rejected and then return to this previous range. Thankfully, price consolidates for 3 trading sessions before a lovely breakout here. And this long candle tells me one thing: it's a reflection of positive sentiment, right? Buyers wanted these prices and they pushed it up throughout the day. This is a pretty huge move. Buyers continually slap the ask, pushing price higher and higher. And look, we even see an increase in body size from this candle to this candle. And at this point, the bulls should remain bullish here, right? This is a pretty elongated candle. This reflects positive buyer sentiment. So you expect the buyers to remain bullish and for the uptrend to continue. However, this is where candlestick basics can profoundly help traders. The next day section forms a spinning top. So we have the upper and the lower wicks, and they tell us that there was a push from the bulls and a pull from the bears. But at the end of the day, neither side held an advantage over the other, and that is reflected in the small body, right? So at the end of the day, it opens here and it closes here. It's a pretty short trading range, which tells me that there was a little bit of uncertainty. The bulls weren't able to push it higher, and the sellers weren't really necessarily able to push it lower. So therefore, we have this small body here. A spinning top signifies indecision, and a spinning top forming on a bull run tells me, hey, watch it here, watch price action in the coming days as sellers have come out of the woodwork. So this might be a good time to secure profits. The following day opening price is lower than the close of the previous day. And throughout the session, price continually drops. The same thing happens the following day. It hits this key level. This key level coincides here, right? So it acts as a demand zone. So we do rebound. There's a little bit of congestion, a little bit of consolidation. There is an ascending triangle formation that forms. Right? We break above it, and then we hit a pretty important level here. This level coincides with this level here. I am watching to see if it breaks above it or if we get rejected again, bringing price down further. Fortunately, we break above this level and a shooting star forms, right? The upper wick of this candle indicates a rejection of higher prices. Supply overcame demand. And similar to the spinning top, this candlestick signals to be cautious, and wisdom tells you to take profits. Subsequent candles are important here because they can either confirm or deny the top reversal we see here. In this case, bulls were really never able to regain momentum because as we see in 2 sessions, there's a formation of a bearish engulfing candle pattern where price gaps up, but then is pushed down dramatically. It closes at this specific level, and this elongated candle actually overlaps or engulfs the previous candle's real body. What we see here is very similar to the bullish candle we observed earlier that initiated the bull run. This is simply the evil counterpart. Higher prices were rejected, selling pressure was induced, and the bulls were never able to regain momentum, bringing price down dramatically. It consolidates on this level, which coincides with what we see here. These levels could not hold. Price dropped further, and I don't know if this looks familiar to you, but this is simply the opposite of this bearish engulfing. Instead of a 1 candle green, 2 candle red, we have the opposite. We have a 1 candle red and a 2 candle green, which means buying pressure. Price gap down, bulls brought price higher. This second candle completely overlaps the real body of this red candle here, which means these lower prices were rejected and buyers wanted to return to this support level. I won't go any further, but as you can tell, there is a nice steady increase as time goes on. A good stair step in the right direction. So all things considered, candles show a strong dimension of analysis by revealing the strength behind moves. Candle charts can key you into potential reversals in 1 to 3 sessions. Understanding candlesticks and where they form on a chart increases the probability in making timely trades. Referencing the APT chart again, traders that failed to recognize the shooting star pattern or the subsequent bearish engulfing pattern would have unknowingly held onto that stock, hoping for a trend continuation. But in reality, the available evidence should have signaled a momentum shift and to secure profits accordingly. It's important to note that trends don't always end abruptly. In fact, trends usually occur slowly in stages as the underlying psychology changes. Trend reversals or shifts are a modification in market psychology and can occur over various timeframes. Although we see the bearish shooting star at the top of the uptrend, the bearish reversal was not confirmed until 2 sessions later during the bearish engulfing pattern. So understanding the candles and understanding the context in which they are formed will profoundly help you enter and exit trades. So Japanese candlesticks pack 4 components into single price bars, and they record the same 4 prices. We have the high of day, we have the opening price, we have the closing price, and then we have the low of the day. The color of the bar is dictated by the opening price and the closing price. If the close is lower than the open, then the candle takes on a red color as a security that falls during a session is viewed as being bearish. And if the close is higher than the open, the candle body takes on a green color as a security that rises during a session is viewed as being bullish. Colors can be interchangeable. Old historical accounts used white instead of green as being bullish and black instead of red as being bearish. And the wider portion of the candle measures the distance between the session's open and close. And this wide body is called the candle body or the real body. The more distance between the two, the wider the candle. The thin vertical lines above and below the real body are known as shadows, wicks, or tails. So this would be the bottom tail, for instance. These upper and lower wicks represent the session's high of day and the low of day, right? So it doesn't matter what color candle it is. The upper wick represents the high of day and the lower wick represents the low of day. When we view a unique candlestick, it provides an immediate clue into whether the bulls or bears are in control. On the left, sellers were in control as price closed at a lower price point than at open. And on the right, buyers were in control as price at close was higher than price at open. Although we may perceive red bars to always be considered bearish and green bars to be bullish, there are special circumstances where this is not always true. it is important to know where the candlestick is formed and the story behind the candlestick. Okay, so let's talk about time frames. Time frames refer to the duration in time for a single price bar. For example, if we are looking at the weekly time frame, then each price bar represents 1 week of trading activity. On the daily time frame, each price bar here represents 1 day. So right here, I recorded this on October 1st. This represents the trading session for October 1st from 9:30 a.m. to 4 p.m. Eastern. And then on the 1 hour time frame, each price bar represents 1 hour of trading. Because regular market trades between 9:30 a.m. to 4 p.m. Eastern, 7 1 hour candles constitute 1 full day of trading. So you have a more fine scale, detailed look at a trading day. All major trading platforms offer time frames like the 5-minute, 4 hour, daily, weekly, monthly, and yearly charts. The general rule is that the longer the time frame, the more reliable the signal is being given, and the shorter the time frame, the charts become more polluted with noise. Swing traders may use the 60-minute, the daily, or the weekly. Day traders looking at intraday trades may use the 2-minute, the 5-minute, the 15-minute, or 30-minute charts to define short-term trends. And long-term traders may look at the daily, weekly, and monthly time frame. But it's all up to your discretion, whatever you prefer, and which trading style you implement. So in the previous slide, I mentioned that lower time frames can give false signals and noise. This also relates to trips plays, such that TA and primarily candlestick charting is less effective for 000 stock. And you may ask, why is this the case? Why is TA a little less effective for trips plays? And let's take a look at this chart here. Notice how this trip trades. In general, they predominantly fall in 1-tick increments, forming these very narrow candle bodies, or they form dojis, which I will talk about in a later slide. Because they trade within a narrow range, trips plays tend to consolidate heavy within these areas, right? So look, this massive consolidation. We have a little bit of decline here, but otherwise it's a pretty consolidated range. Therefore, you don't see much dynamic trading, and we need dynamic trading. We need the ebbs and flows to create candle patterns and chart patterns. And when these candle patterns form, then other technical indicators prove more useful. When it comes to trips, I primarily look for a stock trading on support. In this case, I'm looking for an entry around trips 1 or trips 2, and I am waiting for a slow and methodical stair step higher, or I'm buying low in anticipation of a future catalyst that may boost price higher. Either or are a good return on investments to me. This right here is definitely a pump and dump, a collective push higher, and then that group or groups collectively sold, pushing price down. So this was basically a superficial push. The following are the common levels of bullishness and bearishness for particular candles. On top, we have increasing buying pressure from right to left, and on bottom, we have increasing selling pressure from right to left. In other words, the candles are ranked from least bullish to most bullish and least bearish to most bearish, respectively. Let's start with the least bullish candlestick here. And for each of these candles, we will use a 1-day time frame. So price opens up at the low of the day, buyers push price up pretty dramatically, and then sellers came with such force and pushed price back down slightly above opening price. Since the stock closed higher than the opening price, the candle is green, and we call this an inverse hammer. Although we have a green candlestick, this candle is superficially bullish. I wouldn't really even consider it bullish, to be honest. And you may ask, why is that? Especially because it's a green candlestick. And it's because although bulls managed to push price higher and higher, unfortunately, by the end of the day, the bears took the reins from the bulls and pushed price way down near the opening price. It's important to note that at one point in time, this candlestick, the least bullish candlestick, looked identical to the most bullish candlestick. They both open at this bottom level. They rise to the high of day, creating an extended green body. But where the most bullish candle closed at the high of day, the least bullish candle experienced increased selling pressure at the tail end of the day. The difference between these two candles is closing price. The longer the upper wick, the stronger the bearish sentiment because higher prices were rejected. So on the surface, these candles are green and therefore are perceived as being bullish, but the stories of these two candles are overwhelmingly different. We have next the neutral bullish candlestick. It is also referred to as a spinning top, and it's formed by a candle with a tiny real body with somewhat even lengths of the upper and lower wick, or there may be no wicks at all. The important identifying trait of the spinning top is the small real body. So for the spinning top candle, buyers and sellers are almost equally matched here, but the fact that the session closes slightly higher above opening price indicates buyers have won this round. However, the narrow real body, despite being green, tells us there's really no strong advantage from either party. In other words, there's indecision between the bulls and the bears. The lack of emotion demands context when we see spinning top candlesticks. And what I mean by context is where does this candle form on the chart? So imagine we have 4 consecutive red bars, and then we see the formation of a bullish spinning top interfering with this downtrend. The fact that we see this opposition in the form of a narrow spinning top tells me selling pressure has slowed and buyers have entered the party, and they opposed any further downward movement. But before we predict a reversal, we need to look at the overall picture. Did it occur on support? Did it fall below the 200-day moving average? Did it form in no man's land? Is the stock overextended? So the more information we have, the more informed we are with our trades, and all of this comes into play. And it's especially important with candlesticks like the spinning top that indicate uncertainty and that there is a potential change in market psychology, which might indicate a potential reversal. And then we have the middle candle here, and it's the normal bullish. This candle has a reasonably long rear body and upper and lower wicks of roughly the same lengths. So sellers pushed price down slightly at opening bell, but buyers quickly stepped in, brought price higher to this high of day. It was slightly rejected, but buyers were able to maintain this closing price, ultimately forming this normal bullish candlestick. I do like these candles. The overall formation of them and the story behind the normal bullish tells me that, yes, there was a little bit of selling pressure, but overall, the candle indicates positive sentiment. And it's a good trend continuation candle. So now let's look at the second most bullish candlestick, the hammer. Interestingly enough, at one point in time, this bar looked nearly identical to the most bearish candlestick here. So for the hammer, price opens at this point. Immediately, sellers push price down considerably. At this point in the session, the formed candle is wide ranging in red. However, buying pressure increased dramatically, driving price higher and higher until they closed above open, forming this green narrow body. As you can tell, a hammer is depicted by a relatively small real body and long lower wick here. Any candle that has a long lower wick should immediately clue you into a strong rebuttal from the bulls. Shares were bought up despite attempts by sellers to keep price down, and it is without question one of the most bullish candlesticks, especially if it forms at the bottom of a downtrend. So next up, we have the most bullish candlestick, and it's also coined as a Marubozu candlestick. Marubozu is the Japanese word for dominance. They are extremely powerful candlesticks because when an extended green Marubozu candle is formed, it means that the stock opened at a certain price, climbed higher and higher and higher throughout the session without ever dropping. In other words, bulls were in complete control during that entire period. Additionally, if this wide-ranging green candle had a small upper wick, it can still be considered the most bullish green Marubozu candle. These candles indicate strong positive sentiment, right? I mean, if the bulls were able to maintain this momentum throughout the entire session without any selling opposition, then it obviously indicates positive sentiment. You can expect these candles to form in response to positive PRs, for example. So there is some debate on whether the green Marubozu candle is more bullish than the green hammer candle. In my opinion, one is not really better than the other. Although there is one important distinction between these two candlesticks, the hammer candle represents a back and forth action between buyers and sellers, right? It opens at this price. There's large selling pressure that was actually met with opposition by a strong battalion of buyers that push price higher and higher. Whereas the green Marubozu candlesticks, on the other hand, they opened at one price and steadily climbed higher and higher. And this trading session, the buyers actually received no opposition from the sellers. So the story behind the green Marubozu candlestick was not one of a tug of war between buyers and sellers, but rather buyers held that strength for the entire duration. So then we must ask ourselves, how strong can a move really be in absence of any opposition from sellers? At least for the green candlestick, the buyers had to fight tooth and nail to bring price back to a new high of day. And that's a pretty strong sentiment if you ask me. So I went into pretty good detail on the bullish candlesticks. I am certain you can apply what you learned about the bullish candlesticks to the bearish candlesticks, as I do not plan on going through this content at this moment. If you understand the stories behind the bullish candlesticks, then I believe it's a smooth transition to learn the bearish candlesticks. Remember, long bottom wicks represent what? Strong buying pressure in response to initial selling pressure. What does a tall upper wick tell us? It tells us higher prices were rejected, sellers regained momentum, and pushed price down considerably. The bearish spinning top maintains a nearly identical story to the bullish spinning top, and the most bearish candlestick is simply the negative counterpart to the most bullish candlestick, right? This represents bearish sentiment that lasted the entire session. Up next is one of my favorite topics, doji candlesticks. So we just examined candles that had substantial real bodies, but what do we call a candle consisting of little or no substantial real body? We call that a doji. For a doji candlestick, the opening and closing prices are the same or near the same, right? So open closing price, same with all of these. Open and closing prices are identical, or they can be nearly identical and still be considered a doji. The open and closing prices being identical tell us that there is an equal pull between the bulls and the bears. And at the end of the day, neither party held an advantage over the other. Upon their appearance, you should pay close attention to where it forms on a chart and what candle or candles form after it. When it appears in an uptrend, especially if it forms in a zone of prior resistance, it can signal to us that the prior uptrend is losing steam. If a doji forms on key support, for example, after 5 consecutive red candles, then it signals to us that the prior downtrend is losing momentum. Naturally, the candles that come after a doji appearance play a critical role in either confirming or negating the potential turn. A single doji is intriguing, but we need bullish or bearish confirmation to give weight to any type of reversal. So let's take a look at these doji. We can compare the doji star, the long leg doji, and the 4 price doji to a spinning top, such that they all represent indecision, or we can infer supply and demand are at a gridlock, illustrated by identical or near identical open and closing prices. When you see one of these 3 doji on an uptrend or downtrend, for example, you should immediately think of uncertainty regarding the current trend. They aren't sexy reversal signals by themselves, but they are important nonetheless. So in Steve Nison's book on Japanese candlesticks, he states that doji are more valuable at calling market tops than defining market bottoms. In other words, the appearance of a doji on an uptrend is a stronger reversal signal than seeing a doji on a downtrend. However, the dragonfly doji is an exception. The implications of a dragonfly doji on a downtrend is even more significant, especially if it occurs on support, which is shown with this lime green line. So the dragonfly doji forms with the open and close near or at the high of the candle. This candle has bullish implications. Its lower long shadow shows that the market fell sharply during the session, but buying pressure pushed price back up to close or very near close. The dragonfly doji resembles a hammer, but without the real body. So for the moment, bulls are in control. However, if the next candle falls to the downside and closes below the dragonfly doji's low, then this signals that the downtrend is continuing, right? It breaks and closes below the support, which is pretty bearish. Naturally, if the candle that forms after a dragonfly doji rises above it, and culminates in a long green candle body or any other bullish candle line, then the potential trend reversal signal is given by the Dragonfly Doji, right? This is a nice reversal here. It's important to note that doji are more influential when they are a rare occurrence. If numerous doji have formed on a particular chart, do not view the development of a new doji as meaningful. This relates to the trips chart that I showed earlier. There were moments where we saw 10 to 15 doji appearing within a 3-week span. And when we have that many doji, the strength of this particular candlestick is diluted in a sense. So here we have a period of consolidation. Remember, individual candlesticks are important, but so is context. Notice the numerous doji candles within this trading range. This has to mean something, right? Wrong. Remember, the strength of a doji comes from signaling potential top or bottom reversals. As such, the emergence of doji during a period of consolidation is not important because the indecision derived from a doji coincides with the indecision seen during sideways trading. In other words, a doji tells us there is a tug of war between the bulls and the bears, such that open and closing prices during one session are identical. This is the same concept as consolidation. It's a push and pull between bulls and bears over the course of multiple trading sessions. Because of the overlap here, doji are unreliable signals during consolidation phases. So let's return to the chart. Here is the consolidation I mentioned earlier. So this green Marubozu candle confidently breaks through this resistance. Unfortunately, the move does not hold. Next section gaps up, but drops precipitously. It penetrates about 40% into the previous green candle's body. Notice the decreasingly bearish candles, right? There is large price movement for this long red candle here. Pretty big negative sentiment for these candles here, but the size decreases over time. And within 4 sessions, we see something that somewhat resembles a spinning top. What does this mean? Well, it's obviously a dramatic shift in bearish sentiment from the initial candle in the downtrend. And this tells me selling pressure is diminishing. Furthermore, there's a 100% retracement back to previous support, right? So this is where the trading range was. It pops up, and the point to which it returns is the same level here. So therefore, this is a 100% retracement. When viewed together, it signals to me that I should watch for a reversal signal. Lo and behold, the following session forms a dragonfly doji. Not only is the appearance of a dragonfly doji keying me into a potential reversal, but the fact that it forms on this key support is super important to me. This demand zone is eaten up by buyers, and the reversal occurs immediately. When you hear the word reversal, you'd expect the old trend to end abruptly and then reversing to a new trend. But that isn't always the case. Trend changes can occur gradually as the underlying psychology shifts gears. A trend reversal signal implies that the prior trend is likely to change, but not necessarily reversing at that immediate moment. So here we have a stock that rallied hard. The market consolidates on this new support level, but bulls were unable to hold this move. We see 4 red candles followed by Dragonfly Doji. This represents indecision. The lower wick isn't necessarily long, but it does indicate that buyers brought price up after an initial sell-off. The following session, we have a spinning top, which represents what? It represents indecision, uncertainty. So the subsequent candle gaps down and slightly ends red. So there isn't an immediate reversal after the appearance of this doji, but we are coming closer to this support level. And these 2 candle bodies are relatively small and narrow in comparison to these 4 bearish candlesticks here. We have 4 candlesticks with relatively substantial bodies that tell us there is bearish sentiment, followed by 2 candlesticks by a doji and a spinning top that both indicate indecision. For those reasons and the fact that we are nearing this key support level, I am looking for any potential signal to the upside. The following day, we see a dragonfly doji And like I said earlier, a Dragonfly Doji tells us that there was a nice bull rebuttal to an initial sell-off. And the lower wick nearly touches this key support, and all of this combined, right? When I look at all of this together, I am thinking that there should be a reversal in the near future. Obviously, the next candle is super important, right? If the next candle actually gaps down and closes below this doji's low and closes below this support level, then we are continuing the bearish trend. However, the following day, price opens at the same open and close as the Dragonfly Doji, and it actually rises. It closes above the previous 3 candlesticks, almost 4 candlesticks, and it continues to rise up here. So this key level that I identified earlier from this resistance level was a pretty big demand zone. Buyers were waiting for price to hit around this level, and once it came close enough, they snatched up these shares, bringing price higher and higher and making new 52-week highs. So this next section highlights hammer and inverted hammer patterns. I will provide brief descriptions of all four, but real life examples of the candles in action will only be provided for the bullish hammer and the bearish shooting star pattern. This is because these candlesticks have been deemed statistically ineffective reversal signals from technical analyst Tom Bulkulski, who is the author of the prominent book Encyclopedia of Candlestick Charts. And from my experience, I have not really found them as important in the OTC markets. Nonetheless, there is nothing lost from learning about these patterns, and perhaps you can find utility in their use. So first up, we have the hanging man and the hammer. The overall shape of both candles are identical, but they have different meanings depending on where they appear on a chart. The hanging man appears on an uptrend and a hammer appears on a downtrend. Both are recognized by 3 criteria. The first being the real body is at the upper end of the trading range. It's important to note that the color of the real body is not important. What's important is whether it occurs on an uptrend or downtrend. However, it is a stronger reversal signal when the hanging man has a red body and the hammer has a green body, as the color symbolizes which direction momentum may be shifting. Number 2, they have long lower shadows, long lower wicks that should be at least twice the size of the real body. And number 3, there should be little or no upper wick. For a hanging man, it indicates that buying pressure is diminishing, while demand has steadily pushed price higher. On this particular day, the market experienced strong selling pressure. It is true that the buyers obviously stepped in and brought price back near open, but the initial sell-off is an indication that a growing number of traders think the price has reached its peak. The hanging man's bullish counterpart is the hammer, which occurs on a downtrend. So sellers enter the market during this price decline, but buyers absorbed this selling pressure and pushed price near the open. Hence, we have a long bottom tail, which is a telltale sign of solid buying pressure. Don't forget that hammers, like other candlesticks, do not alone indicate a price reversal to the upside. We, of course, need bullish confirmatory signals. Now for the 2 candles on the right, we have the inverted hammer and the shooting star, both of which also have narrow real bodies, long upper wicks that should be at least twice the size of these real bodies, and little or no bottom wick or bottom shadow. Again, the only difference between the inverted hammer and the shooting star candlestick formation is where they appear on a chart. An inverted hammer appears on a downtrend, and a shooting star appears on a uptrend. An inverted hammer is considered a bullish reversal candlestick. Here we have a gap down, and it gaps down from the previous close of the red candle. The gap down actually coincides with the current downward trajectory. However, this immediate gap down is reversed by the bulls. Buying pressure pushes price higher. These higher prices are rejected. Selling pressure increases in response to this, bringing price down near open. Next up is the shooting star, which is a bearish reversal candlestick that forms on an uptrend. The shooting star signals a change in momentum from up to down, with the bulls forcing price to peak. These higher prices get rejected, bringing closing price near where it opens for the session. The selling pressure observed here should theoretically continue during subsequent sessions. As such, the formation of the shooting star indicates a potential price top and reversal to the downside. So here is a great example of a bullish hammer in the context of a bottom reversal pattern. On this chart, we have a clear downtrend that retraces, do you know how much? This is a 100% retracement because it falls to a level that where it initially began. It pops, it decreases, it creates this perfect triangle. This level coincides with this level. Therefore, it is a 100% retracement. During this downtrend, we take notice of the bottom tail of this red candle touching this 0018 support. Remember, humans are emotional traders. We operate in patterns. The market participants understood that the sub 1719 zone acts as key support based on where it traded earlier, right? This 100% retracement is a key level to watch out for during this downtrend. Since it broke one, it broke below two. Next up is this support. The following candle is a doji, which represents indecision, which is fantastic because this indecision forms on support and it forms after a long downtrend, indicating that there is an equal tug of war between the bulls and the bears, and no party really has an advantage over the other. Lo and behold, the next candle is a bullish hammer, which says what? It shows that initially sellers take price down below this 0018, but at the end of the day, buyers were able to come into full force and bring price near open. So after the bullish hammer, a green normal bullish candle forms. The next candle is a red candle, right? That pierces through this downward trend line, but it does not hold. So it's the 1-2 punch. You want it to pierce through and then hold. It gets rejected. Price returns to this 0018 support zone with a bullish hammer. So two bullish hammers form on this support line, which means buyers are willing to hold this level. They are not letting price fall under. As such, you could buy confidently around this area, right? So now we're just buying at 0017, 0018, 19, whatever you're comfortable with, and waiting for price to rebound. The following session, we have this pretty bullish candle that breaks above, it closes above. This piques my interest, and the following days, we actually hold this new support before making a new road northward. So let's talk a little more in depth about the shooting star. Again, they have a narrow real body, an upper wick that is at least double the size of this body, and there should be little or no bottom wick. Because this is a single candle, it should not be used as a reversal signal by itself. As with all inverted hammer and hammer patterns, the color of the body is not important, but it'd be nice to see a red candle for a shooting star because it symbolizes which way momentum might be shifting, right, towards the downside. An ideal shooting star has a real body that gaps up from the previous green candle. However, the gap up is not completely necessary for the success of the trade. Let's look at an example. We have a shooting star here. What you should key into is the market is on an obvious uptrend. We have this candle gapping up from the previous candle's close. We have a narrow real body. We have an upper wick that is at least twice the size of this real body. And we have a bottom wick that is very minimal. And the color is red, which symbolizes which way the momentum might be shifting towards. But again, it can be green as well. Since price is rejected from these levels, if the market is strong, 0028 should act as future resistance. So right now we are down here at 0012, but as price continues to climb higher and higher, 0028 is going to be an important level to break and hold. Otherwise, we might see another rejection. So this shooting star by itself is an important candle to look out for, especially on an uptrend, because it shows that increasing selling pressure is opposing this bull move. However, as I mentioned earlier, it's important to note the subsequent candles. Right here, we have a very large real body that fully overlaps not only the previous candle, but the previous 1, 2, 3, 4, 5, 6, 7. This body right here overlaps the previous 7 candles. That's a pretty big move, right? That's pretty large negative sentiment. And it tells us that this selling pressure here, transition into the next day, it transitions into the next day, and it actually continues to climb down, right? It holds this support for a brief amount of time, but the bulls were never able to regain momentum. Price continues to dwindle, and it returns to 0011, 0012 around this area. This is a what percentage retracement? 100. This is where the move begins. It gets rejected and it returns to these levels. These levels coincide with where it began in the beginning. Therefore, it is a 100% retracement. Next up, we have a bullish engulfing pattern. It's composed of two candles. We have the first being red and the second candle being green. So during a downtrend, a red candle forms. Sellers believe the current downtrend trajectory is still intact. However, the subsequent candle is an extended green candle whose green real body completely engulfs or overlaps the body of the previous red candle. For engulfing patterns overall, you can ignore the wicks. The main thing is for the body of the second to overlap the body of the first. This is a very popular candle formation, but context really matters here. As I mentioned earlier, it forms on downtrend breakouts, as it clearly demonstrates the downward trend has been tested by the bulls. We can increase the strength of this signal if the two candle pattern appears on support. However, despite indicating strong buying pressure, this is but a short-term reversal, and we do need bullish confirmatory signals to signal a move to the upside. Let's look at this one more time. We have a market that's on a downtrend. It is nearing a support level shown by this green line. Price gaps down. The bears assume that the downtrend is intact, right? It gaps down. They assume that it's going to continue falling. However, buyers came into full force, bringing price up considerably. The subsequent green candle that is formed swallows the previous red real body right here. And that is what makes up a bullish engulfing pattern. So let's look at another example of a bullish engulfing pattern. Immediately when I look at this chart, I can tell that right here is a very important support level, right? Don't look at this. Look right here. So price climbs up. These high prices get rejected. It returns to this support level. This is based off of this right here. This acts as key support. It pops again. What is this right here? We see a bearish engulfing pattern. It's simply the evil cousin of the bullish engulfing pattern. We have a subsequent downtrend. I mean, 1, 2, 3, 4, 5, 6, 6 red candles in a row. It tries to hold the support, but it falls, and it falls where? On this key support that is based on these right here. These are all key levels that you need to look out for, especially when we're watching for a potential entry. Again, price fails to hold at this level. It falls, it gaps down, it touches the support. Market opens lower than the close of this previous candlestick. It falls even lower. Bears are salivating at the mouth. They assume that because it gaps down and continues to fall, that price will eventually return to, let's base it off this right here. It'll probably fall to 003, 004. However, this is a false breakout to the downside. The bulls were essentially waiting at this demand zone. They know that this holds well based on these 2 points right here. They held this pivot point, bringing price up, 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 getting rejected here, but then still falling at a decent price. The formation of this green candle is large and in charge, and it completely overlaps or engulfs the body of the previous candle. Therefore, this is a bullish engulfing pattern. However, we do need to see subsequent candles, and we do have a nice candle here. It's a nice run up. Instead of climbing even higher, though, it does trade sideways for a little bit before eventually stair-stepping higher. So now we have the bearish engulfing pattern, which is simply the evil cousin of the bullish engulfing pattern. In this scenario, the market is trending higher. Context matters here. We have an uptrend, again, similar to the bullish engulfing. Instead of a gap down, though, we have a gap up. So it gaps up. The bulls still think that the uptrend is still intact for these reasons, right? It climbs a little bit higher, but bam, this resistance rejects higher prices. Increasing selling pressure continues to wind down until we close here. With the great distance between open and close, we form this very bearish wide extended range candle that completely overlaps or engulfs this candle right here. Remember, the bullish and bearish engulfing patterns are two candle patterns. So the first is typically the same color of the uptrend. The second candle is the opposite. So in this case, it is red. The red overlaps the body green, which signals to us that the uptrend is currently being opposed by sellers. And with the emergence of strong selling pressure, we do need bearish confirmatory signals to signal a move to the downside. Okay, so I do want to mention there are three factors that increase the likelihood that an engulfing pattern could be an important turning signal. Number one, if the first day of the engulfing pattern has a very small real body. So in this case here, we have a narrow bodied spinning top. And following this small body is a nice bearish candle. That right there indicates a shift in momentum. The small real body reflects a dissipation of the prior trend's force, and the large second real body proves an increase in force behind the new move. Number two, if the engulfing pattern appears after a very fast move, as a fast or extended move creates an overextended market and makes it vulnerable to profit taking. So if we experience a parabolic move, right, within one or two trading sessions, price increases by 500%. At this point, you can imagine that a majority of people are going to take profits. And with people selling their shares to secure profits, we will experience a subsequent downtrend. Number three, if there is heavy volume on the second real body of the engulfing pattern. So when we piece all of this together, we can increase the probability of a winning trade. In this instance, we are increasing the odds that we might experience a top reversal to the downside. If the uptrend is nearing a known resistance level, there will most likely be plenty of sell orders here. And unless there is strong buying pressure that can push past this resistance level and then hold it, there's a good chance that these high prices might get rejected, and then we will see a subsequent decline. So let's look at an example of a bearish engulfing pattern in action. There's a slow stair step, breaks above the resistance, holds 3-day consolidation, strong move upwards. Within this period of congestion or consolidation, it forms an ascending triangle. It breaks above this triangle, holds, a subsequent rally occurs. We have a shooting star, which signals to me there is some opposition from sellers. We have another green candle here. Following day, the market gaps up, but immediately gets rejected. Price drops pretty drastically and it forms a red Marubozu candle. This bearish candle is unusually long with no upper wick, telling me that the strong bearish sentiment was maintained throughout the trading session. This red Marubozu candle overlaps the real body of this candle prior, forming a bearish engulfing pattern. Supply has overpowered demand. So price consolidates at 1.2 cents. It drops again. We have a slight gap down, gap up. This candle engulfs the previous red candle right here, forming a bullish engulfing pattern. Yes, this is also the chart that we looked at earlier. And then we have a subsequent move up. And this bearish sentiment continues for another 5 candles until they finally find temporary support around 1.2 cents. And it's important to note that if the market is strong, the highs of this bearish engulfing pattern should act as future resistance. So I have provided details for a few candlestick patterns so far. And before I move forward with more examples, I want to emphasize that candlestick patterns are not 100% guaranteed. Remember, TA is not perfect. If traders are acting erratically, or if a collective trading group decides to pump a stock and all 50 of them sell large chunks into the bid or market sell, for example, then the erratic trading can really mess with the theories behind these popular candlestick patterns. However, I also want to emphasize that reading charts can help you make informed trading decisions. Understanding and implementing TA increases the probability of a trade working in your favor. It's not a precise science, but it is an art. So anyways, I want to talk about this chart here, and I want to talk about two separate time frames that reveal the overall picture. On this one-day chart, we are witness to a long period of consolidation, and this consolidation is followed by a steady climb up where the market makes higher highs and higher lows. On this session here, price gaps up, makes a new high, but these prices are rejected. A subsequent free fall occurs with the market closing below the open close of the previous day, forming a bearish engulfing pattern. And with what we know about this pattern, then we should watch for a bearish confirmatory signal, right? A bearish engulfing pattern doesn't automatically mean that we are going to see a 50 or 100% retracement back to 2 cents, right? It's a potential reversal signal. So subsequent candles are important. Despite this long extended range candle, fortunately for the bulls, the following day gaps up from the previous day's close and remains in a relatively narrow trading range. The next day price gaps up again, does a similar thing. Market trades in a relatively short trading range with minimal upper and lower wicks. The next 5 days consists of 5 candles, but they are composed of spitting tops, so relatively narrow bodies. But just because we see 5 consecutive red candles doesn't suggest there's a major bear move about to happen. Yes, closing price is below open for these candles, but the short bodies let us know that there's simply no strong sentiment from either side, while simultaneously four out of the 5 candles, they actually make higher lows. So it's a slow and methodical stair step / consolidation. So let's check the separate time frame, the 1 hour chart, which shows us the same prices as the 1 day chart, but in finer details. Each candle here represents 1 hour instead of 1 day of trading. So let's go straight to the peak here. In the previous chart, we saw the bearish engulfing pattern. Here it is spread over multiple candles. It hits this support, but notice how support does not fail. The final red hourly candle touches support. The next day we see a fantastic reversal. I mean, this recurs relatively quickly. It stair steps higher, making these higher lows and higher highs. And remember when I said that the high of the bearish engulfing pattern should act as future resistance? Well, it definitely did here. Price trades within this range. And once we broke out of that technical and psychological resistance, we witnessed the bulls take off with this pretty bullish candle right here. And this bullish story culminated despite the formation of the bearish engulfing pattern we witnessed here. As with everything, candle patterns can be important reversal signals, but I cannot overstate how important it is to look out for confirmatory signals. The trading session after the red bearish candle actually gapped up and stayed within a narrow range. People longing the stock should not have sold on the red bearish candle alone, as this could be a false breakdown to the downside. Traders selling on the bearish candle alone are failing to make informed decisions and are therefore losing money in the process. In a different world, if this green candle here would have gapped down instead and closed below the low of the end of this bearish extended range candle, then that would be a sign that the trend is continuing to the downside, right? However, price actually held the support, gapped up, and eventually stair stepped higher and higher. So here we have another top reversal pattern called a dark cloud cover. It's a 2 candle pattern that appears on an uptrend. The first session should be a strong green candle coinciding with this strong uptrend here. And the subsequent candle opens above that prior high. However, by the end of the session, the candle closes near the low. And the low point here should penetrate the previous green candle's body at least 50%. Therefore, it is called a dark cloud cover. The foreboding pattern indicates that the bears constrain the bulls. If the red real body does not close below the halfway point, for example, if the penetration was approximately 40% or so, right, like 40%, 30%, we can still call this pattern a dark cloud cover, but the strength of the pattern overall is diminished. And you should watch for further bearish confirmatory signals that really reinforce this potential reversal. So let's look at a chart. There is an obvious uptrend. I mean, look at that. All I see is green. That is amazing. It moves from, let's see, trips 7 or so, all the way up to 0032-ish. I mean, that's a pretty bullish run. Typical of the dark cloud cover, we see a nice green bullish candle here, right? The market is ascending. We see a nice green candle and a long bottom tail representing strong buying pressure at the end of the day in response to this initial sell-off, right? That's pretty bullish to me. On the next session, price opens up higher, coinciding with this uptrend here. Price gaps up. Bulls should be pretty confident at this point. I mean, thus far, the bulls are in complete control, right? They think that the uptrend is still intact, but then the whole technical picture changes as sellers pushed price well within the prior candle's real body. The real body of this red candle penetrates further in. Let's say that's about 60%, offsetting much of the gain of the first session, right? All of this gain is basically offset by this candle penetrating 60% within its body. As this is a potential reversal signal, it would behoove us to wait for a confirmation signal, right? In this case, it's a hanging man followed by an extended range red candle after that. I mean, look at that. This is crazy negative sentiment. And the following day, we open where the close is, we gap up, but we just cannot maintain the support, right? We were never able to regain momentum. There was such a strong move up. This was about a 10 bagger that so many folks were trimming profits. Lots of sell orders were triggered. There were probably a few market sells as people were panicking, right? They're panic selling. And all of this combined after this nice run up results in a pretty substantial decline. So what could make this pattern, the dark cloud cover, even more powerful? Let's say the uptrend is nearing a key resistance level, right? So we had this very strong uptrend, higher lows, higher highs, higher lows, higher highs. And then here comes a critical point, right? This is such an important junction. Are we going to get rejected from 0033? Or can we break this resistance, hold it, possibly climb higher, or even consolidate on this level before making a northward climb again? We are on this uptrend. We see this nice green candle that's confirming the uptrend. The following day, price opens up. Bulls are assuming that we're going to pierce this line, this key resistance, and break through it, right? We're going to go towards blue skies. However, even though we gapped up, price immediately drops. So what does it tell you? Well, it tells me higher prices have rejected this upward movement, and therefore there might be a shift in momentum to the downside. Okay, so next we have a piercing line, and it is the bullish counterpart to the bearish dark cloud cover. So the piercing line is frequently seen and does best in a bear market. Naturally, the more oversold the decline, the more significant the signal may be. So let's look at this pattern. Number one, we are in a bearish market. Number two, a bearish candle forms, reinforcing this current downward trajectory. The third step in this is an initial gap down. Again, this coincides with what we see here, a downtrend. However, price rebounds. There are plenty of buyers here that push price up considerably. And don't forget that the close for the second candle here must close at least halfway through the prior candle's body. It can close 30 to 40%, and it's still considered a piercing line pattern. But again, you really want it to close above the midpoint, right? That's such a bullish signal. And of course, we want to confirm the potential reversal, right? So the next day, we want price to close above this high. This says that bulls are here, bulls are buying up shares, and they want to push price higher. What we wouldn't want to see if we were looking for a bottom reversal is for price to close anywhere within this green candle and then to immediately drop, closing below this candle's low. If we had the subsequent candle closing below this low, then it essentially tells us this current downtrend is still intact and there is no bottom reversal happening. Of course, there are false breakouts to the upside and the downside, so be careful and make sure you watch these bearish or bullish confirmatory signals. Okay, so let's look at the piercing line pattern on an actual chart. So immediately when I look at this chart, I notice that there is an important price level around 10 cents. At this point, 10 cents acts as resistance. We fall it down, and then we come up. We test it here with this upper wick. We can't break through, but then within 2 days, we do break through and we hold. So now previous resistance now turns new support. Now moving forward, 10 cents will act as support, and it's an important level to watch for a potential reversal. So there's a strong rally to 14 cents or so. And then we have a culmination in a very narrow real body with unusually long wicks. This could be called a spitting top, but in my opinion, this is not a spitting top. It's actually what is considered a high wave candle. Remember, a spitting top typically has very short upper and lower wicks, whereas this here, it does maintain the same body length characteristics as a spitting top, but these unusually long upper and lower wicks make it known as a high wave candle. This high wave candle is the first candle in a sequence of 4 increasingly bearish red candles that make up this downtrend. Small body, larger body, larger body, bam, negative sentiment up the wazoo. The following day, it gaps down pretty hard. And where does price fall? It hits this 10-cent mark. Remember, I identified this area as an important level to watch out for in the future because it has acted as resistance. And now the 10-cent mark is support. So the next session gaps down below the previous session's low. We touch the 10-cent mark. At this point, the bears are salivating at the mouth. They want to take price lower. However, buyers came out from the woodwork at this demand zone, right? They were waiting for price to hit this. They wanted this dip opportunity. They don't want price to fall beneath this. This is a key level. This is a critical level. So buyers come out of the woodworks at this demand zone. They gain momentum and close around the midpoint of the previous red candle. The bears are now second guessing their position. And although the reversal did not immediately pop, we did climb up, but then we returned and hung out around the support area before finally testing the 14, 15 cent mark again. All right, next up is the 3 white soldiers pattern. As the name implies, it is a 3 candle pattern that appears on a downtrend. And remember that the green and red candle colors can be interchangeable. They used to be white for green and black for red, which is why this pattern, the 3 white soldiers, and the next pattern, the 3 black crows, are named why they're named. But of course, we have changed the technical colors since then, but we still refer to this pattern as the 3 white soldiers and the next pattern as the 3 black crows. In this pattern, all 3 candles are green, tall, and they must open within the body of the prior candle and close higher than the prior candle. Again, all candles are tall and they must open within the body of the prior candle. So here's the first candle. The second candle, it opens within the body of the prior. The third candle, it opens within the body of the prior. And these candles close higher than the previous candles. So we have the second candle in the formation. It closes higher than the prior candle. Third candle in the formation, it closes higher than the previous candle. So when you take all of that into account, we have what is called the 3 white soldiers. And to include a few more details of this pattern, all 3 candles must have no wicks or very small wicks, meaning buyers were able to close the prices near the high of the session. Some descriptions of this pattern note similar sized candlesticks. Other sources say that the second candle must be bigger than the body of the previous candle, and then the third candle must be bigger than the body of the second candle. It's really up for debate. It depends on which textbook you read. It depends on which source you take into account. But overall, the pattern is composed of 3 bullish candles appearing after a nice downtrend into support. It bounces off real nice. Then we got 1, 2, 3 white soldiers that tell us, hey, this downtrend has been terminated and we are looking for a move to the upside. Some analysts, such as Tom Bukolski, mention that the breakout is a relatively short one. In other words, buy the breakout and set your stop loss at the previous low. Watch the trade carefully to ensure an uptrend is actually intact. Otherwise, cut your position if it develops against you. As guidance, this candle pattern is quite rare to spot. After scouring through many charts, I could not find one instance of a 3 white soldier for an OTC ticker. Granted, I primarily looked at one-day charts, and this pattern can be used for other shorter time frames, such as the 30-minute or hourly. And although I couldn't find an example, the purpose here is to educate you on the specific pattern so that you may identify it in real time and trade accordingly. And this pattern specifically, 1, 2, 3. So this is a pretty big move already, especially after a downtrend. And know that not all moves to the upside are parabolic, right? It's called stair stepping for a reason. I like slow, methodical grinds, not bam, 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 10 green candles in a row. So once we do hit the 3 candle mark, sellers may want to get in there, right? Shareholders may want to secure some profits and sell some of their shares. And that's why Tom Bukolski mentioned that the breakout is a relatively short one. It'll break out initially, but it's not going to go for another 5 green candles. That's just not typically how charts move. Of course, there are anomalies, right? You'll get candles that move for 2 weeks straight, green, 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 but that's not always the case. There's a small move, consolidation, a small move, consolidation. So it's just something to look out for. Next up is the bearish counterpart to the 3 white soldiers. It is the 3 black crows. And remember, I guess nowadays we call it the 3 red crows. This pattern is represented by 3 consecutive red candles that form at the top of an uptrend. The overall performance of this pattern is great because a close below the bottom of the candle pattern marks it as a bearish reversal, but price has to climb and close above the first red candle to mark it as a bullish continuation. So with price at this low, it's much easier for a downward breakout than an upward one to occur. Remember, humans are emotional traders, and the emergence of this bearish 3 black crow pattern will cause traders to panic sell and or market sell, solidifying the reversal. In other words, once this 3 black crows forms, it's much easier for the trend to continue downward than it is for price to continue climbing higher and then break above the initial first candle to mark this as a bullish continuation, right? It's super difficult for that to happen. Once you're already at this low point, it's easier for people to panic sell. It's easier for people to market sell. It's easier for price to continue climbing down than it is to climb back up. All right, let's look at the black crows in action. Okay, so my first thought when I see this is we have a little bit of consolidation. We have a break above resistance. We hold this, which is lovely. We have more buying pressure here. We're forming new 52-week highs. Of course, at this point, we go from 0018, 0019, all the way up to 0037. What does that mean? It means people will be taking profits. Welcome to the stock market. That is okay. Don't vilify people for taking profits. It is what it is. So we hit these 52-week highs. There's a top reversal that occurs. We retrace about 100%. And as this reversal happens, there's one key level that I am looking out for. It's about the 0034 to the 0037 mark. This is a key resistance that I should be watching out for. So the reversal happens. We pop 55% here. We test these levels twice, bop, bop. Both times they're rejected. For this specific trading session, it forms an identical candlestick to this one right here. And because traders are emotional humans who trade patterns, who trade trends, they notice this, right? There's no way that they don't notice this. The second candle opens within the previous candle's body, but immediately falls. The same thing happens with the third candle here. As such, this 3 bearish candle downtrend forms the 3 black crows. So moving on to the subsequent candle following the 3 black crows, we have a candle that opens within the prior candle's body, and it opens at the high of day and immediately drops. It drops so far that it cuts under this support level. The following day is a super important one because it can either confirm this downtrend or the bulls can bounce back and then hold this support again. Remember, if the candle after this long candle right here closed below its low right here, then it confirms this downtrend. However, it does not do that. It opens and closes within this candle body. It holds this 0019 support fairly well. And it even increases, but it drops down to the support. It increases again, but then it drops down to the support one more time. So it's holding the support fairly well. And I would expect a nice reversal in the short term. Next up is the morning star pattern, which is a 3-candle bottom reversal pattern. The first candle is a wide range red body, affirming bearish sentiment. The second candle gaps down from the previous candle's body. And this candle has a small body, hence the star in the pattern's name, that does not touch the previous real body. The shorter body tells us that selling pressure is decreasing. And the third candle can gap up from the star, but it does not necessarily need to gap up to be considered a morning star. However, an ideal morning star pattern would have the gap between the first and the second, and a gap between the second and the third. Nonetheless, the strength and success of this pattern is not dependent on the second gap. The most important part of this pattern is the middle candle, and it must be a spinning top or a doji. So let's get back to the third candle. The third candle closes at least midway into the body of the first red session. In the example here, the third body completely engulfs the first candle, which is perfectly okay. And it indicates to me that bulls are working diligently to regain momentum. So in a perfect world, price would rally following a morning star. However, let's not forget that trend shifts do not always occur immediately following reversal signals. So there's an obvious downtrend from about $76 to the mid 60s. And this is where the morning star pattern forms. We see a white or red candle that gaps down, and there's even a gap up between the second and the third session. Of course, the star pattern is a spinning top, letting us know that the selling pressure from this downtrend is losing steam. The third white candle or green gaps up from the spinning top and closes well above the first candle's high. There is one issue though. Because the morning star pattern is a 3-candle pattern, you would have to wait until the close of the third candle to complete the pattern. As is usually the case, if the third candle is wide ranging, like it is here, we would get the signal well after the market already had a sharp bounce. Therefore, this may not be the most attractive risk-reward entry. An alternative option is to wait for a correction to the morning star support area. In other words, if the third candle gaps up hard and continues climbing high, which it does, it closes above the first session's high, then you should wait for the subsequent candle, the fourth candle in this case, to see where it lands. Once this pattern forms, I would not necessarily buy yet because I want to see whether this is a short reversal or if it's going to be a true reversal testing the $75, $78 range. As you can see in the chart, price holds the $69 range pretty well and eventually starts to climb northward. So the reversal did not happen immediately after the Morningstar pattern. However, it's important to recognize the pattern on our chart and understand its role in predicting price reversals, and that it may take a few days for the bulls to take control. Okay, so let's look at an example for an OTC stock. Looking at this chart, there's an obvious uptrend, a bearish engulfing pattern that starts a 4-day red move. The third and fourth candle in this downtrend are part of a Morningstar pattern, right? We have the bearish candle confirming this downtrend. We have the gap down. We have the spinning top characterized by the narrow red body. The third session, of course, we gap up. Again, this increases the strength of this overall pattern. So it gaps up and bulls push price higher and higher until we close well beyond the high of the first session. As I mentioned in the previous slide, this is a pretty large bounce. There's a Hawaiian word kilo that means to observe. In this circumstance, it's important to be patient and kilo the aftermath of the Morningstar pattern. Remember, there isn't going to be an immediate parabolic move. This is a great move by itself. Let's see if we hang around support before we make subsequent moves northward. So on the fourth day, price opens and closes within the third candle's body. And as the day progresses, we see price respecting 00, 27, 28 support. These small bodies show uncertainty. Neither the bulls or the bears hold an advantage over the other. And then we see a nice move from 0027.28 to about the 40 range. These prices get rejected and price returns to this key support, right? Once we popped here and we got denied and we consolidated at these price ranges, obviously I want a breakout to the upside, but also there's always a possibility that we'd see a breakout to the downside. And that's exactly what happens. And once I see this move occurring, I tell myself this is a good time to either enter a position or continue dollar cost averaging at these dips. And of course, after touching this key resistance multiple times, we have a nice reversal. Remember what I said earlier, if we are in a strong market, the tops of these top reversal patterns will act as future resistance. And that's exactly what this does. We try to test this resistance, but we do not have the buying pressure to break and hold above it. We get rejected and we fall lower. Let's go over the next candlestick, which will be the evening star. It's simply the reversal of the morning star pattern. The evening star pattern occurs on an uptrend and is represented by 3 candles, the first being a wide-ranging green candle. The second candle is a narrow range candle that gaps up from the first candle. And then the third candle in the pattern is a wide-ranging red candle that closes sharply into the first session's green real body. As I stated for the morning star, an ideal evening star is characterized by a gap up between the first and second, and then a gap down between the second and third. However, the second gap between the second and third candle is not necessary. The most important component is the third bearish candle body penetrating at least 50% into the first real body. And a downward breakout occurs when price closes below the low of this candlestick pattern. If we had price gap up and then close up here, this close is higher than the high of this pattern. Therefore, this is a trend continuation. For a top reversal evening star, we will want the subsequent candle to close below the low here. And this close below this candle pattern here indicates that a top reversal is on its way. So earlier I mentioned that there is a doji equivalent to the morning star and the evening star, which means the middle candle or the star in these two patterns are doji candlesticks instead of spinning tops. So let's look at an evening doji star pattern next. In this example, there's an obvious uptrend right here. There's a quick retracement that is initiated from this, what is this right here? A bearish engulfing. It retraces to this key level, does an immediate reversal, and as we climb higher, we are going to test a previous resistance, right? Again, this high, oh, this is actually a shooting star. So the shooting star forms the high of this session here that gets rejected. If the market is strong, will act as future resistance. Lo and behold, as we climb up and we climb up, we begin testing this resistance. During this retest, a strong wide-ranging candle forms. The next day, there is a slight gap up, and the day is characterized by really short price movements, indicating indecision. The open and closing price are identical in this case, and we have a long-legged doji that tests this resistance. At this point, it tells me one thing. It tells me that this uptrend right here is diminishing in strength. So I see this green formation, I see this doji star, and I think, oh, there's a possibility that the next candle might be a wide-ranging red candle, which completes the evening doji star formation. The third candle in this formation, it does not gap down. It opens at the same price as the previous doji, climbs a little bit, touches that 3.2 resistance, and then drops immediately. It closes well beyond the first candle's body, and it actually completely engulfs this body of the first green candle. And then we can look at the bearish confirmation that follows this 3 candle pattern. We have a open within the candle body. There is no new high of day. It opens at the current high of day and immediately drops. Selling pressure continues tremendously. Bam, 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 bam. As I mentioned earlier, the gap between the star and the third candle does not need to be there for this to be a completed evening doji star pattern. The main thing is the gap up, the doji star appearance, and then the third candle penetrating at least 50% into the first session's body. I'm not going to go over the morning doji star pattern, but the defining criteria are nearly identical to the morning star pattern, except for the middle candle being a doji instead of a spinning top, obviously. These patterns have good reversal rates, and you should always be on the lookout for these top and bottom reversal patterns. So this next section will include a few reversal indicators that are generally less powerful as compared to engulfing patterns, morning, evening stars, piercing line, dark cloud covers. Up next are the bullish and bearish Harami patterns. The overall performance for these two patterns are near random when predicting trend reversals, and they are more often than not continuation patterns, not reversal patterns. However, you can increase the probability of a top or bottom reversal if you see these candle patterns forming at key resistance or support. Context matters. Please do not forget that, because a bullish Harami pattern occurring during consolidation is meaningless. However, if we saw a bullish Harami forming on support in an overall bearish market, then that signals selling pressure has slowed and we should watch for a reversal or consolidation prior to a reversal. So let's talk about the bullish Harami pattern. Here we are looking for a tall red candle in a downward price trend. The next session is forming a narrow body green candle, and it is nestled within the body of the prior candle. For this pattern, we can ignore the wicks. The important part is that the second green body is completely engulfed by the prior red candle. It's essentially a reverse bearish engulfing. The second candle in the Harami pattern can be red or green, but I prefer it to be green as it symbolizes which direction momentum may be shifting. Up next is the bearish Harami, and it indicates a slowing down of buying pressure during an uptrend. So the bullish green candle's vitality is followed by the small real body's uncertainty. In addition, the spinning top opening and closing within the prior bullish candle's open and close range is another indication that the bull's upward drive is diminishing. Thus, it signals sellers may be preparing for a top reversal. Unlike engulfing patterns, the two candles recognized in a Harami pattern do not have to be opposite colors. This is because the story stays the same, as the narrow spinning top within the previous candle's open close range tells us buying pressure or selling pressure for the bullish Harami has diminished considerably. Nonetheless, for a bearish Harami pattern, there is more strength behind this move if the first candle color is green and the second color candle is red. Like the bullish Harami pattern, the bearish Harami pattern supposedly signals top reversals, but in reality, they function almost randomly, with reversals taking a slight edge over continuations. That means you can't confidently guess the breakout direction with any crazy accuracy. Nonetheless, we should understand the pattern in case we see it nearing a key resistance level, as the psychology of the pattern signals a shift in market sentiment and therefore a potential shift to the downside. So similar to the morning doji star and the evening doji star cousins, the bullish and bearish Harami patterns also have their own doji cousins, and they are the bullish Harami cross and the bearish Harami cross. Because doji candles are characterized by very narrow intraday trading ranges, they are a stronger signal of uncertainty in the market as compared to the spinning tops here. As such, bullish and bearish Harami crosses are powerful reversal signals as they indicate a change in market sentiment. So here we have an example of a bearish Harami pattern, and the Harami pattern tells of a narrow candle body being contained within the prior candle body. There's an obvious uptrend. A very bullish green candlestick forms, indicating there is positive sentiment. And the following day, price opens within the body. There's a pull, there's a push from the bears. However, at the end of the day, closing price is near opening price. So it indicates what? Indecision. It indicates uncertainty. It indicates that this current uptrend is being opposed by the sellers. It's important to note that the high of this two candle pattern, which is located on the second red candle here, this is the high, it's at 0.0028, acts as future resistance. So when this price gets rejected at this point and it returns to this previous support level. There's a nice reversal here. At this moment, I am looking for another retest of 0028 cents, which is exactly what happens. And if we wanted to go further in this analysis, price returns after this bearish shooting star to a previous support, which is about 0013. Unfortunately, it does not hold. So the moment that this breaks, I would set an alert at 001 in preparation for a potential bounce at trips 8. And why is that? Because trips 8 acted as support for about 2 to 3 weeks prior. So therefore, once this support breaks, I'm looking for an entry around trips 8, trips 9. And of course, if you did that, you would experience a nice bounce here, returning to this level, right? Once this broke, it became new resistance. It used to be support. Once it broke under, this is the new support. Now 0013 is the new resistance. So you could have bought at trips 8 or trips 9 and set a sell limit at 0012 or 0013, trimmed your position at that point. And that's just another example of trading price action and where to enter and where to exit a trade. Next up are the tweezers candle formations, and tweezers are two candle lines with matching highs or matching lows. They are called tweezer tops and tweezer bottoms because they are compared to the two prongs of tweezers. So for a tweezers top, we're looking at matching highs. So in a rising market, a tweezers top is formed when the two consecutive highs match. So two matching highs, two matching highs, two matching highs, two matching highs. The tweezers could be composed of real bodies or wicks and or doji. Ideally, the tweezers should have a long first candle and a small real body for the second candle. This shows that whatever force the market had on the first session, bullish force with a long green candle and bearish force with a long red candle, this force was dissolving with the following smaller bodied candle. And there are variations of candlestick patterns that actually fall under the umbrella of a tweezer's top. For example, here we have a bearish Harami cross, and because they both share identical highs, then it's also considered a tweezer's top. Candle theory says that the pair is supposed to be a bearish reversal because it illustrates overhead resistance. However, be careful when using the two candle pattern as a top reversal because its predictive performance is weaker compared to some of the previous candlestick patterns. So of course, watch for bearish confirmatory signals. The opposite of a tweezer's top is obviously a tweezer's bottom. So in a falling market, a tweezer's bottom is made when two consecutive lows share identical prices. So the first candle operates within the bearish downtrend, long candle, long red candle, long red candle, long red candle. And the second candle can be a multitude of different forms as long as its low matches the previous candle's low. However, as mentioned earlier, an ideal tweezers would have a narrow, small body for the second candle because it shows a potential shift in sentiment and therefore trend. It is supposed to be a bullish reversal because price stopped at the same low twice, signaling a support area. It's not an overly strong candlestick pattern, but watch out for a break above the pattern's high. So let's say this is the third candle, this formation. It can open wherever, but it needs to close above these candles high because that is what signals a trend to the upside. If the candle opened within the candle body and they close below the candle's low, that's simply a continuation of the current downward trajectory, whereas the tweezer's bottom is a bottom reversal signal. Here we have a tweezer's bottom in action. Here's a 3-candle move nearing support. A nice extended range candle forms on support, and the following days open and closes within the first candle's body. The lower wick touches the same support, and we do see a lower wick about the same size of the candle body here, indicating that buyers have absorbed some of this selling pressure. Because of the shared low between these two candlesticks and that they both occur on a downtrend, we can confidently call it a tweezer's bottom. A few days later, price breaks above this formation's high, and we do see a nice move up. However, this level is rejected. It's a key level, supply demand area. It gets rejected and price falls and returns to this 001 support area. And going back to the tweezer's bottom, of course, this is also known as a bullish harami, as the real body of the second candle is completely engulfed by the prior session's real body. Tweezers are not the most significant reversal signals, but when they are used in combination with other bullish or bearish candles, or if they are trading within a channel between known support and known resistance levels, they can definitely be useful trading patterns to capitalize on. And tweezer tops and bottoms on the weekly and monthly time frame can be important reversal patterns. So look at the large scale trends of a stock, and if a tweezer bottom forms, then it could be an important reversal signal. Next up are the belt holds. First is the bullish belt hold. Again, candles with extended real bodies can display strong signals, especially when they touch support and resistance zones. The bullish belt hold is an individual candle line that forms on a downtrend. It is a strong green candle that gaps down, right? This is the opening price. The previous candle closes here. The following session, we gap down. So the bears believe the downside momentum is still intact. However, price immediately climbs higher, closing at or near the high of the session. So essentially, the bullish belt hold is a candlestick that is putting its foot down right here and it says, this is enough. We are going to reverse. I'm going to give you a long bullish green candle to tell you that this downtrend is broken. And for the subsequent candle following the bullish belt hold, you would not want the subsequent candle to close below the bullish belt hold's low, because that means there is a continuation of the downward trajectory. What we have here is an open and close within this candle body, and there is a natural stair step higher, right? And eventually we close above the high of the bullish belt hold. And once we close above that, once you break and hold it, that means the trend is now to the upside. It is no longer to the downside. So the bullish belt hold as an individual candle line put its foot down and said, this downtrend is going to be broken. It is time for a reversal. So the pattern is relatively easy to identify. It is a single elongated candlestick forming on a downtrend that indicates bullish sentiment. So even if we look at the overall chart, we'd immediately see right here, dead center, there is a strong bullish candle, right? There is no upper wick, there is no bottom wick, and it is clearly within this downtrend here. Immediately, I'm thinking bullish belt hold, because where it lands, price level is about 2.3 cents. This price level coincides with previous resistance points. For one here, it breaks above, but it can't hold. It tests this resistance again. It breaks above, it can't hold, and it falls below until eventually it gaps up. It trades within this range. And therefore, once trading within this range, that 2.3 cent price level is now new support, right? Previous resistance has now turned new support. So once we see this formation of a bullish belt hold forming on this important support level, I'm looking for a nice reversal here. So if we look at the bullish belt hold candle in a little more detail, we notice that there's a gap down from the previous close. We gap down to the 2.3 support level, and bulls come into full force. They take advantage of this demand zone. They buy up all these shares and they push price to around 3.5 cents. Of course, subsequent candles are important. A close below this open is a sign that the downward trend will continue. What actually happens is price gaps up, which would be a nice confirmation to the upside. However, despite gapping up, prices are immediately pushed down by sellers. They must have taken advantage of this nice uptrend here. So people are taking profits, which is totally okay. And the following day is also red. We trade sideways for a few trading sessions, but bulls were never able to regain momentum to really test the 5 cent mark, to test the 6.5 cent mark, and eventually the 10 cent mark. We trade sideways for a few days until selling pressure brings price back down to this key support level around 2.3 cents. This is simply another example that candlestick patterns do not work 100% of the time. Understand these patterns, recognize these patterns in real time, but make sure you act on confirmation signals such as support and resistance levels, subsequent candle signals, or other indicators such as volume or RSI, which is a momentum indicator. Up next is the bearish belt hold. Again, it is a single candle pattern similar to the bullish belt hold, making it easy to identify. They form on uptrends, and the significance in this candle lies in the size of the candle. It should be wide ranging, and it should lack an upper wick, which means that the bulls never had control. It opens here and immediately selling pressure brings it down further. It demonstrates a switch in trader sentiment, and belt hold lines gain value as a reversal signal when they have not appeared regularly on the chart's recent time frame. Although it's a single candle pattern, you should always act on bearish confirmatory signals before entering or exiting a trade. For the subsequent candle, a close above the bearish belt hold should mean a continuation of the uptrend. For a bearish belt hold to actually be completed, you'd want the subsequent candle to close below this candle's low. So you see this, it hits resistance. You're saying to yourself, oh, there's a possibility that there's going to be a trend reversal to the downside. Let's see what the subsequent candle does. And it opens below and it closes below the bearish belt holds low, which means that this uptrend has been blocked and there is a good possibility that the trend reversal is ensuing. So when looking at this chart right here, we have a market that is steadily rising. Nice pop, little consolidation, a little dip, but eventually we have a nice move north. Bulls possess control of the market. This trend seems to continue because after this day, the market opens at a new high. However, price declines during the session and closes at or near the low of the session, forming a very elongated red candle. In this instance, we have a dark cloud formation. It pops up, it gaps up, and it closes well beyond the midway point of the previous candle. So with the appearance of the bearish belt hold or the dark cloud cover, you would not want a close above this candle because that indicates a continuation of the current uptrend. What actually happens is price gaps down. We open at this point, which is below the close for the previous day, and then we close below the low of the previous day as well. That is pretty bearish to me. And throughout this period of consolidation, there are really no strong bullish candles that indicate buyers are willing to push price higher. So during this period of congestion, support doesn't hold, and lo and behold, sellers push price further down, back to this level right here, which is around 0.004. And if you have learned anything from this lesson, then you should know that humans love patterns. So as I'm watching price decline further and further, I am referencing this support level to be a new landing zone for this current decline, which it does. Once it hits this level, it consolidates pretty well. However, watch as these candles lower and lower and lower. They're making lower lows. There's lower lows and then lower highs, which is indicative of a downtrend. So this support fails to hold, and then we see price continue to degrade over time. Next up is the upside gap to crows. The upside gap refers to the gap between the real body of the first candle and the real body preceding it, right? So this gap's up here. The body of the preceding green candle is usually a long green one. You do not necessarily need the gap up between the long green candle and the first crow, but it is viewed as being less bearish than would be the case if there was a gap. The two red candles are the crows in this pattern, as they depict crows peering down ominously from a tree branch. The second crow in this pattern opens higher than the previous crows open. However, this gap up is short-lived as price falls and closes under the first crow's closing price. In essence, we have something similar to a bearish engulfing pattern. The difference is for a bearish engulfing pattern, the first candle is green, and a bearish engulfing pattern doesn't require a gap up. Let's look at an example here. The market should be in an uptrend. We have a gap up on open. Higher prices are rejected, and we actually see a bearish shooting star. I mean, look at this massive upper tail. The new highs fail to hold, and the market forms a red candle. Nonetheless, the closing price of this red candle still holds above the prior day's close. The following day, we experience another nice gap up, but watch as price tumbles considerably. The session closes under the prior day's close. Also, it closes under the prior day's lows. Again, the body of the second candle completely engulfs the body of the preceding crow, similar to a bearish engulfing top reversal pattern. So after this nice rally from the double 13/14s to the mid-20s, we quickly witness a change in momentum when the new highs for these two crows fail to hold. The bulls here are nervously questioning the integrity of this uptrend. We see two spinning tops here, but again, the bulls were unable to hold these prices. Then we have bam, long red candle, and eventually we see a near 100% retracement. So I have talked a great deal on candlesticks, and I truly hope you have gained something from this lesson. The beauty behind candle charts are they are easy to understand, they provide early indications of market reversals, and they ultimately improve market analysis. As you learn and review the different candle formations, you quickly notice how each candle tells a unique story. Moving forward, the best advice I can give you is to continue charting. Learn about candlesticks, understand the story behind them, and apply this knowledge to your charts. Examine different time frames. Look at the 1 day, look at the 4 hour, and don't forget to pull up the weekly chart to gauge the overall picture. If you have converging bullish indicators over multiple time frames, then make the trade. The technical conviction is there. And do not forget to chart intraday or in real time as well. Open a shorter time frame up at 9:30 a.m. Eastern and try to predict price movements based on what you are seeing on the chart, related to volume, related to momentum indicators, related to price movements with respect to support and resistance levels. And if the play doesn't develop in your favor, pull up the chart at the end of the day and figure out what went wrong. Failure is inevitable in trading. Every failed trade is a learning opportunity, so it's your responsibility to learn from your mistakes. I love technical trading and I want to share it with you all. Learning the basics of candlesticks is a powerful tool because as humans, we have a tendency to see patterns everywhere. For example, if different traders and entities see a bearish shooting star, then everyone is cautiously watching for a break to the downside or a continuation of the current uptrend. A subsequent red candle results in profit taking. As a result, this distribution of shares drops price. And this is part of the reason why TA works. TA is not like Santa Claus in that you believe in TA or you don't. TA is simply another tool in your trading tool belt. Use it in conjunction with fundamentals, and you could be confident that your decision making is based in sound judgment. I want you to succeed. I truly do. And I hope this video helps you in your trading career. With that being said, I bid you farewell and never stop learning. Aloha, my friends.